If you have over $200,000 sitting stagnant in your bank, retirement account, or home equity, then you're literally losing money. On this show, you learn how to get that money working for you consistently and conservatively. Learn to grow your nest egg with your host, Shawn Winslow. Let's dive in.
Welcome back to another Multifamily Monday episode. I'm your host, Shawn Winslow, and this is the Multifamily Money Podcast. What's going on, everybody? You know the drill. Every Monday, we're coming at you all things multifamily real estate investing. We have solo shows breaking down from my experience investing in multifamily. We've got guests that break down their experience in the industry. And we're all just coming on here to try to, impart a little bit of wisdom maybe we've come across in our path, and just talk shop and hopefully provide value to you, the listener. Because after all, we're all here to create the lives of our dreams. And for me and a lot of the guests I have on, this investment vehicle is one of the best, if not the best, to create all your financial and personal dreams. So without more being said right now, I want to introduce our guest, Mark Khuri. He's with SMK Capital. That's his company. And they're a private equity firm, so they invest their investors' capital into deals that others operate. And so we talk about how the due diligence that it takes to find solid operators with great track records that they can trust their investor capital with. And so Mark, this is pretty cool. Mark invests in what he and his company consider recession resilient asset classes, and those include affordable housing, which is tax-exempt multifamily, mobile home, and so on and so forth, self-storage, and they also do some ATM business funds as well. So we talk about all those asset classes, why they like them, a little bit about where we think the market's going, and just his story on how they got to where they are today. It's a really, really great conversation with a seasoned real estate investor. I think everyone will get a lot out of this. So without further ado, here is Mark. Hey, Mark, welcome to the show.
Hey, Shawn, thanks for having me. Happy to be here.
Hey, man, it's great to finally connect here. I'm just excited to get into the story. We've talked a little about what you guys do before I hit record, but just give the listeners some background on Mark and SMK and what you guys are up to and how you got there.
Sure. So I have a finance background, Shawn, similar to you. I worked in corporate America from 2002 to 2010. A lot of financial analysis, budgets and planning, some auditing, et cetera. And through that journey, I started investing in real estate in 2005. I did that very actively. Bought a place, fixed it up, took out some equity. My brother and I partnered. We bought another place. Took way too long, spent too much to fix it up, and learned a lot along the way. And then another and another. By 2010, we had basically just been partnering with my family members, my folks, my brothers, some cousins, aunts, uncles, finding some pretty good deals back then, Shawn. Through the recession, we're still buying. A lot of it was distressed, straight from the bank, foreclosures, REOs. A lot of single family, small multifamily, typically 12 units or less. A lot of heavy lifts, boarded up when we buy them, and need a lot of attention and love to get them to where we want them to go. But we built up a pretty good sized portfolio for a little family of capital, and we decided to go out and really just keep going. And so we started our company, SMK Capital Management. That's my father and I's initials. I left my W-2. I had a 401k kind of just sitting idle, Shawn. Once you leave corporate America, there's, what do you do with it, right? You can't get matching, et cetera. So I opened up a self-directed IRA, transferred a lot of those funds into that so I could invest passively into other kinds of investments that we wanted to diversify into. And then this was 2010, 11. So at the time, Shawn, there wasn't a ton that you could say, oh gosh, look at how well it's done, right? And so, But there was some. I went on a ton of networking events. I met a lot of really sophisticated, what I call expert investors, and just listened and took a ton of notes. Started investing in mobile home parks and self-storage, some apartments, larger, institutional quality. to diversify, and found that some of these asset classes had weathered the recession quite well. And then fast forward today, that's a lot of what we do today, Shawn. We focus a lot on recession resistance. We invest in kind of, I would say, 4 different predominantly asset classes: apartments, self-storage, mobile home parks, and ATMs. And we're essentially a private equity company. We partner with other operating partners to bring capital and some due diligence to specific deals that we like.
That's awesome. All right, I got a lot of questions now, so let's hope I don't forget them as we go. So first, you mentioned you obviously were doing this as, I don't know if side hustle is the right word, but you still had a full-time job. How long did it take you from when you started to when you left that W-2 job, and was that a difficult decision?
Gosh, yeah, it was definitely difficult. I wanted to leave so many years prior to actually leaving, Shawn. It's hard to get out of that comfort zone. You get a paycheck every Friday or whatever, every other Friday. And you're young, so you also don't know what you don't know, right? So it took me, I started investing in 2005, and then I went full time in 2010. So 5 years.
That's pretty solid, though. First to make that decision, because I know it's not easy, especially if there's other people in the group that you got to convince too, right? If you got a family.
Oh yeah. I mean, thankfully I didn't have children, which we do now. My wife and I have 2 kids. So that helped, of course. I think having to do it a little later in life would be even harder. It did also help, Shawn, that there was a recession. So the company I was working at, it didn't have a very bright future through the Great Recession. And so that was also, everything kind of all aligned itself. I wouldn't change a thing as far as, I wish I had done this sooner, that sooner. As far as my career path goes. But it all worked out, I guess, huh?
Seems like it. And similar to you, obviously there is that comfort level, right? When you, like you said, you're getting that paycheck every other Friday or whatever it happens to be. You think there's security there, but now that I've been able to step back, and I don't know if this is the same for you, but you look at a different lens, and you, at least from my standpoint, you realize it wasn't really security. It's kind of just an illusion, because like you said, that company wasn't doing so well. So is that really security? Or like what's happening now in the world, there's a lot of layoffs and you're just a number, and you're laid off. Is that real security? We're made to believe, by the institutions that it is security, but to me, it's not. And that's one of the main reasons I wanted to leave. I wanted, the power in my hands, of like the power of my future, right? Or the direction of my future in my hands. I wanted to work for my dream and not, someone else's. So that's kind of how I viewed it.
Yeah, well said. I would agree. I did read, of course, as many of us have, Rich Dad, Poor Dad at a relatively young age. And that helped me realize, okay, growth is probably not going to be achieved significantly with a W-2. And so that helped as well, just different paths in life. Because, I went to school for finance, but they don't teach you much about personal financial planning, which
that's for sure. Yeah. And like I told you, every Friday we have a Finance Friday episode, and that's kind of the information I'm trying to, share with everyone, because you're absolutely right. It's not taught anywhere. And, I'm not wearing a tinfoil hat, but, who knows if that's done for a reason or not. Right. Yeah. But whether it is or not, it's people need this education.
Agreed.
So you mentioned affordable housing. And I feel there's not, at least consensus wise, there's not a clear definition. So Mark, how do you and SMK, how would you define affordable housing?
Sure. For us, it's housing that can be reasonably afforded by the local population. And so there's formulas there too, Shawn, right? You look at area median income, which is published annually for every zip code in the country, AMI for short. The lower income limit is 80% of AMI, and the very low income limit is 50% of AMI. And so if you have units that you're renting, whether it's apartments or whatever it might be, that somebody with an 80% AMI can afford, then you're essentially providing affordable housing. And so another way of looking at it too, it's like, the rent to income ratio, which many of us look at closely, a 30% rule where a tenant's rent plus utilities are no more than 30% of their gross income. And so if you have an apartment that's $1,000 a month, you're looking for one or two, ideally residents, tenants that combined are making $40,000 a year in income. And so that's essentially the definition of affordable for us.
Yep. And yeah, I feel like a lot of people, when they hear that, they think, Section 8, which is affordable housing, but that's not the end all be all. So like I would consider, and maybe you correct me if you don't feel this way, but I would consider, mobile home parks, it's affordable relative to like your traditional market rate. And it's too bad that there's the NIMBY, the not in my backyard, because we could really do with more development of mobile home parks and other affordable housing like that. Cause and we could probably get into this. I'm sure you have statistics, but it's a real issue in our country with affordable housing.
Oh yeah, it's a massive issue, Shawn. It's growing, and we think it's a long-term trend, which is some of the reasons why we invest in affordable housing. We also find opportunities in this sector that we find are very favorable from a risk versus reward standpoint. Really attractive returns can be had. And we love mobile home parks, as you noted, Shawn. We also love, tax exempt apartments, where we keep 50% of the units affordable by definition. The other 50% are at market rate, and you can get a property tax exemption as a public-private partnership with the local municipality. And so these are some areas of affordable housing that we like to focus on. We've done some Section 8 in the past, Shawn, just don't focus on it that much anymore. Mm-hmm. We're really just finding a little bit more of what we call a sweet spot from that risk versus reward.
Yeah, and break down the tax exempt, because I'm not too familiar with that. I've personally never done it. So it's, if you're keeping at that ratio within the properties, however many number of units, I think you said 50% are affordable, then the municipality, what kind of tax cut is that they give you on?
You usually get your property taxes exempt.
Okay.
For 99 years.
Oh, wow. And then, so if you were to sell that property, Mark, and I bought it, would that transfer to me?
Yes, it can. Okay. And you can also remove the exemption if you choose and bring all the units back up to market, but then you got to start paying taxes again. So
right.
It's more of a math calculation as to what the cost benefit is of keeping it exempt. And so that's kind of how it works. Yeah.
Okay. That's it. That's interesting. And I'm assuming it's just like any other, multifamily asset class where it's probably marketed. It's just the, brokers they have like a niche buyer that is looking for tax exempt properties.
Well, yeah, I mean, that's part of it. So you find these deals, there could be new construction deals, Shawn, where there might be a partnership created to go and build affordable housing. And then also, where we focus is we're buying market rate apartments. But while we're in escrow, we will then put in the tax exemption partnership with the housing authority. And so by the time we acquire the property, you then have the property tax exemption, which the seller didn't have. And so you've created an inherent amount of value day one. A lot of times, if you're looking at appraisals, Shawn, in this area, you'll look at net operating income that the seller's been producing. And then we'll look at kind of an as-is appraised value. And we looked at the appraised value, assuming the net operating income, which has increased significantly because you're no longer paying that property tax.
Right.
And so you have a pretty interesting situation where when you close on these assets, the appraised values can be significantly higher than what we're actually buying them for. And so that helps us reduce risk because you're creating a lot of value when you buy.
Yeah, you're creating value right on day one you're just restructuring and you're not lifting there's no sweat equity to do that. Right. So anyone who's been in real estate for a long time knows, dealing with municipalities can be tough. So what's the approval process like on that? Is it pretty straightforward? Is it easy?
Yeah, good question. So we partner with other operators, Shawn, that are specialists in this area, right? It's a niche sector. And one of our operating partners has been in the affordable housing sector, and they've used to do a lot of LIHTC, low income housing tax credits. for over a decade now. And so there's definitely a little bit of a specialty there where you need to understand all the bells and whistles. You have to have some relationships, and you also need to know how to put the structure in place. And it's not something that we typically see with like a younger operating partner coming into this niche in this sector and being able to put it in. It's a little bit complicated, Shawn, but also if you know how to do it, you get the right team. Usually there's several attorneys involved on both sides of the deal with the operating partner and also with the housing authority working it out while in escrow. And so there's definitely a way to do it, but it's a little bit cumbersome. It's not that simple, right? Otherwise, I think everybody would do it.
Right. Yeah, easy doesn't pay well. So like that's a good point. Like partnering with people, experience, track record. Obviously the context, right? It's who you know and who knows you. So if you wouldn't mind talking about what is the kind of due diligence you and SMK, Mark, put into, finding an operator and then, giving the green light to actually want to go partner with them?
Sure. Yeah. So, over the years, Shawn, we were an operating partner for many years, right? We would source, underwrite, finance, pick the paint colors, everything, A to Z for an investment. And we started transitioning where some of our investments we would partner with other group. So a lot of those groups initially came to us from referrals, right? Hey, Mark, I've invested with these guys. I've been doing very well. Maybe you should talk to them. And then a lot of times we'll do that. We'll go through some due diligence analysis, which I'll talk more about in a second. But most of the time, we as a family, myself, are investing with those folks as a test to start before we'll bring an opportunity to our investors in our group. And so with that, what are we looking for? I mean, we've vetted and underwritten over 120 different operators, Shawn, over the years in different asset classes. There's a lot to think about there, but what we've essentially created is a process where really what we're looking for is a group that is very good at one thing, and they specialize in an area where you'd much rather join them than try and do what they do because of all the complexities and the years and years of experience it takes to get good at that niche. And so we're trying to find groups out there that are specialists in one thing. We're looking at pedigree, track record, experience, AUM. A lot of times our operating partners in apartments, for example, have over 500 million in assets under management. A lot of them have $1 billion or more in assets under management. So you're really looking for that pedigree of experience. And then you're trying to find a good fit, right? What is it that makes us work well together? And so part of that can be strategy. If the operating partner likes short, kind of get in, get out, a lot of growth versus maybe longer term investments that are more focused on income, distributions, kind of hold in perpetuity, Shawn, or you can maybe have an exit of principal through a refinance and whatever it might be, year 3, 4, 5, and then stay in the deal. You got to understand, how do they think? What are they doing
Right.
this? What's their end goal? Does that align with what your interests are? So those are some of the things. You also want to look at, where have they steered incorrectly and how did they overcome those hurdles, right? And nobody's perfect. If you're talking to an operating partner that's never made a mistake, then that's a big red flag, right?
Right.
Mistakes. So you want to find out what kind of mistakes they've made. What did they learn from them? What do they do differently now? And have they become even better and better through those experiences as an operator? So those are a few things that we like to look at.
I love that. And especially that last part too is, like you said, everyone makes mistakes, and it's how you handle them and how you correct them and how you learn from them. Because I can tell you, we're not perfect, but what we're good at is seeing where those errors stemmed from and how we can, fix them. So I think that's important. But thank you for sharing that, because I think that's a big part in this whole industry, at least that I've seen how it's exploded over the last 2 to 3 years. And I just try to let people know to me, it's more important to do due diligence on the operator than the deal itself. Because if you feel comfortable with that operator, then they're gonna, and they are who they say they are. They have a good track record. They're gonna bring you a solid deal. Obviously, yeah, you got to vet the deal too, but the biggest part is that operator. So yeah, thanks for answering that.
Sure. Yeah. Maybe Shawn, I'll add one more point there.
Yeah.
You bring up a good point, right? You're talking about analyzing and underwriting and vetting people. Then you also have the analysis and the vetting and the underwriting of the deal, which is a little bit more of the science and maybe a little bit less of the art. But for another thing that we look at is like transparency, like how well do they communicate? So we'll look at previous investor statements going back many quarters and just sift through them all. And if they're like 2 pages and vague, that's not necessarily that exciting to us. We're looking for a lot more detail. A lot of times with our operating partners, we are getting weekly reporting on performance of the asset, and then we'll do a monthly call and then do quarterly distribution. So there's a lot more frequency and transparency along the way with different operators that we like to work with.
Yeah, and that's the way it should be. To me, more information is better, right? If you're an investor and you're of the mindset of like, I don't need all that, then fine, tune it out. But it should be there in case, someone needs to look at it. I can remember earlier on, because we do monthly reporting, and then kind of like a quarterly call. And our monthly reporting is we show everything, right? So it's obviously got the income statement and balance sheet, but like we do a variance report too to show them, are we on budget for the different aspects of the business plan. But then we'll also show every bank statement from every bank account that is part of the property. So it'll show all money coming in and out, all checks coming in and out. And the reason I'm bringing this up is because one investor was like shocked that they'd never seen that before, right? And coming from the finance world, Mark, like I thought that was just commonplace and that was something that everyone did. But to your point, it's not, right? And that's something you need to vet before you get into bed with someone.
Yeah, totally. And I will say this: that's awesome that you do that, Shawn. Not a lot of people are showing bank statements, and so I don't necessarily want to tell investors that are going to be investing passively that they should be looking for bank statements. That might be a little too in the weeds.
Yeah.
But it's great that you show that. One thing we also look at is on the asset management side is if we're trying to raise occupancy, we'll track that weekly, right? How many leads did we get? How many conversions? Where are the sources of those leads? Are we running any promotions, any specials? Like really getting into the weeds on asset management. And you will find that step alone can help differentiate operators with really good experience versus those that are maybe figuring out a little bit on your dime.
Yeah, exactly. And yeah, we get that daily, and it's so true because you want to see how are you converting those leads, right? Sure, you could have 10 people walk in the door or call or reach out online, but is that actually resulting in a lease? So yeah, that's a valid point. Are there any markets you guys focus on? Or is it more just, you pick the operator and you go kind of where they go, or is it a little bit of both maybe?
It's a little bit of both. Yeah, I think, based on asset class, it's a little bit dependent. I'll tell you where we don't typically invest. We don't really invest in the Northeast. We don't really invest on the West Coast. We just don't find a lot of cash flow in those markets, and we like cash flow. So the South, Southeast, and then the Midwest are typically where most of our deals are. We've done stuff in, over 30 states, Shawn, we've invested in, over 60 partnerships with our investors. And so I'll definitely say take that with a little bit more of a grain of salt. But like mobile home parks, we're a little bit more market agnostic, just dependent on the demand for affordable housing in a specific submarket. And we do like to be close to an MSA, usually of 100,000 or more people within 20 minutes of that, preferably 500,000 people or more, but a little bit more open there. If there's a huge gap between what a mobile home will be selling or renting for versus a 2 or 3 bedroom apartment down the road, we like to see that there's, usually 30% or more gap between those housing costs for the resident. So then you end up usually having a good amount of demand for the product. Yeah.
Is there a size that you guys kind of target, or at least a minimum?
As far as purchase price or asset, or
I guess for mobile homes, it would be probably what, like pads or
Number
you
of
you
pads.
guys pads, right? And not you tend not to want to buy the actual homes.
Correct. Yeah. I mean, look, 10 years ago, Shawn, you could kind of cherry pick mobile home parks and you
Yeah,
could,
yeah, yeah.
hey, all of your boxes get checked where you could get a 8 to 10% going in cap rate and, 90% occupied, all resident owned. That just doesn't exist anymore because of all the cap rate compression and demand and competitiveness of the asset class. So today there's usually a give and take somewhere. We have gotten more comfortable over the years with park-owned homes and then converting them into resident-owned homes where you can, with a lease with an option to buy or just an outright sale, you can convert residents from tenants to homeowners. And that's what we like to do. And so there's different ways to take a park when you buy it and convert it into a more higher performing, even lower risk investment.
Yeah, yeah. That makes sense. And yeah, the real estate, the competitive landscape, it's just, yeah, everything's changed, right? And I've actually been saying this for a little while. I think, like to your point of 8 to 12% cap rates, real estate used to trade in such like a wide band of cap rates. The market would crash and cap rates would expand like crazy. And then the market would, take off and they would compress like crazy. But I think they're not going to have that wide range, at least not to that extent anymore. Because I think it's become such a huge focus of Main Street. It's not just like a niche asset class where there's a few operators, and I think just more money is going to flow there, chasing yield because the bond market is in disarray. It's not what it once was. So that your big institutional players can't find yield there. They're going to be searching other places. I don't know if you have any opinion on that, but I just feel like that cap rate band which it trades in is going to be more and more narrow.
Yeah, it's all getting worked out as we're sitting here, right, Shawn? The markets are up and down based on a lot of different variables, but of course, interest rates. And so we've already seen, cap rate expansion on a macro level, anywhere from, I would call it 50 to 100 basis points since early 2022 to today. We're in March of 2023. So is there going to be more? We anticipate there will be some more cap rate expansion. We'll see how much, Shawn, but it's still an unknown. So we always pad our assumptions with cap rate expansion in our underwriting to the tune of 50 to 200 basis points, depending on the length of the deal. And so I think we're okay there. But the gap you're talking about, it seems to me like unless you're in like a really tertiary market with a lot of high risk, you'll see a much higher cap rate. So of course you're getting compensated for that additional risk by paying a little bit less. But generally speaking, I think we're on the same page and see that gap possibly shrinking as well due to the competitive nature.
Yeah, and you mentioned underwriting. How has that changed for you all, Mark, in the past like 12 months? How are you looking at things?
Totally. So I'll say this. In 2018, we created a recession-resistant fund. We saw some indicators in the marketplace at the time, Shawn, that made us feel like we wanted to create an investment vehicle that could weather a storm. And so we built a fund that invested in 9 different offerings across mobile home parks, self-storage, and apartments. I think we had over 50 properties across 13 states in that fund. It's done very well. We've returned about a third of our investors' capital from some refinancing events, from some property sales. We've really close to, if not already caught up, our investors' preferred return. And so in that, I mentioned that because that investment, some of our underwriting criteria was medium to long-term hold. We weren't looking at anything that was less than a 5-year investment horizon on purpose. We didn't want to be sellers at the wrong time. And then you fast forward to 2020, obviously the onset of COVID, we stopped investing entirely for 7 months. We didn't make any new investments. We just analyzed everything we could get our hands on, market data, portfolio data internally, our operators, et cetera, trying to figure out if there's going to be a significant amount of distress. We'd never been in a situation where the public was given money in the form and the fashion and to the degree that it was through, of course, checks, just being paid to stay home. And I think if that hadn't happened and it was just the stay-at-home orders and there wasn't the compensation effect, we'd probably be in a Great Depression, right? That's the fastest way to turn the economy off, is to tell everybody to stay home and stop working.
Yeah.
And so through that time frame, we just waited and analyzed to try and determine if and when we should invest, if at all. But by Q2, Q3 of 2020, we started realizing, pretty quickly, Shawn, that there wasn't going to be distress, and actually there was these tailwinds that we were getting of really a significant demand for housing, specifically from residents and from investor groups as well. Rent growth started going through the roof. We really started seeing that demand. So we started investing in shorter term, kind of heavier value add, more fix and flip type multifamily in 2020. And we did several of those deals. And then by 2022, once interest rates started to, of course, creep up as a response to battling inflation, we paused on that investment strategy. We now focus back again on recession resistance, on medium to long-term holds, on a lot of fixed rate agency type financing. And so that's some of the pivoting that we've done in our underwriting and analysis as adjusted to the market conditions. We're constantly looking at things and trying to make sure that we're well positioned and don't want to be a seller at the wrong time. Same concept.
Yep. And I like that you take a macro view first and then break it down. You see what's the economy doing? Where can we, drive alpha? And that's where we'll go. I like that. No, thanks for sharing that. But you mentioned recession. You say, I think, resilient or resistant. And those asset class you mentioned, can you break down why you and your team, Mark, feel that's the case with those asset classes?
Yeah, sure. So we'll just start quickly with apartments, but again, it goes back to the affordable aspect. So most of the apartments we invest in, Shawn, can be afforded by the local population. We're not typically doing a lot of Class A higher rents per unit. Mm-hmm. And you'll find that historically, if you look at more Class B, call it workforce housing, Shawn, it's been a lot more resilient through downturns where the demand for apartments stays strong. And then if you look at mobile home parks, mobile homes are the most affordable housing solution out there. And so they're oftentimes counter-cyclical, where you'll see demand go up during a downturn, during a recession. Some mobile home parks have waiting lists for them, Shawn. I've seen so many over the years, and some of them are really nice. And so, it's not necessarily what some people might think. Of course, there's some less visually appealing parks out there as well. Yeah. We tend to stay away in general from war zones, places with high crime, a lot of poverty, and we just find the risks are high from an investment standpoint there. But mobile home parks have proven to be very recession resistant. There's data from ELS, Equity Lifestyle Properties. That's the largest mobile home park owner in the country. They come out with data every year or two showing their NOI growth going back to the 1990s. There's a really cool chart that we have on our website too. It shows their resilience during different recessions, during different downturns, where they're still able to create positive NOI growth during even 2008 and through COVID. So there's some interesting inversely correlated aspects of mobile home parks. And then self-storage has also proven to be recession resistant. If you look back at some of the REITs in 2008, had a positive growth, whereas most other REITs outside of self-storage were negative significantly. You also see, during tough times in the economy, a lot of people will make a change, and that's what increases the demand for storage, some type of life change, whether it be moving with family, with friends, going to school, those types of changes increase the demand for storage. And so those are some of the reasons that they're top of our list for investing in today, and why we call them recession resistant. But at the end of the day, you're looking for an investment that has a high likelihood of continuing to perform through varying market cycles. And continuing to perform to us means maintaining or continuing to grow the value of the asset and hopefully continuing to provide cash flow and positive distributions to investors.
On the storage, I really like storage as an asset class. Hasn't been something that I personally got into, but from what you said, those are obviously great reasons. And it's like the fundamentals of storage. I like how it's a business. Yeah, it's the vehicle is, it's real estate, but it is a business. Are you guys buying, stabilized assets, or are you developing it? There's been just a huge development in storage you've probably seen this because you're in it day in and day out, but over the last 5-10 years, it's been crazy.
Yeah, very good point. So typically we don't do a lot of development investing, Shawn. It's generally speaking, it's outside of our risk tolerance levels and doesn't usually meet our investment criteria from a return standpoint, since there's no income or growth usually along the way while you're building and leasing up. It's all just a bit out of our comfort zone. Doesn't mean we won't do it, but it's definitely not an area we focus on. Now in the storage world, you nailed it. That's one of, if not the biggest risk in a storage investment is new supply coming online within a close proximity of your facility. And so it's a difficult area to really get extremely comfortable with, especially if you're in a secondary or tertiary market where there's a lot of vacant land that could be developed into storage. It's the lowest, one of, if not the lowest cost to build. If you think about it, you've got very little infrastructure. There's not utilities, et cetera, concrete slab, aluminum walls, et cetera, roof, you name it. So they go up cheaply and they go up very quickly. And so you can see the impact of new supply. If there's too much supply in a market, Shawn, it'll disrupt the performance of all the self-storage facilities in that submarket. We've been there. We've seen that in years past.
Yeah.
You also have some markets where the city, the county, the municipality will come in and put a moratorium. Sorry, there's too much storage here. We don't want any more. Wow. We're not allowed to build anymore. So we've seen that too. So it's definitely a risk. You got to be really comfortable with that. And so most of the storage that we acquire is stabilized at acquisition from an occupancy standpoint, or maybe there's enough occupancy where we can continue to grow it. But there's also some other value add measures that we want to pull on and grow NOI, not necessarily just from development, but you can operate them a lot more efficiently than maybe a mom and pop are. There's varying ways to grow NOI there.
Yeah, and I was just about to ask too, with the municipalities, can it be tough? I know you're not doing development, but I was wondering, it's easy to build and probably one of the most cost effective to build, but is it hard to get approval? And it sounds like it can be, right? If it's oversupplied.
Definitely. Yeah. It all depends on the local submarket, Shawn.
Yeah. And I know you guys are cash flow investors, and I've heard that developing storage, it can take up to 3 years to get occupancy where you want it to. So I could see how that wouldn't be advantageous for a cash flow fund, for sure. But no, Mark, this has been awesome. Before I ask you the final 4 questions, where can the listeners find you?
Sure. Our company name is SMK Capital Management. Our website is smkcap.com. And then our email address is info@smkcap.com.
Okay, awesome. All right, now we're down to the final 4. And as the listeners know, and as Mark knows now, I don't give too much heads up on this because I like to see, kind of the top of the head thoughts on these. And so the first question is, Mark, why, you and I were both in finance. We made a change. So why real estate as an asset class, and what has it done for you and your family over the years?
I think, a common point there, Shawn, that most people are aware of is that there's more millionaires made from real estate than I think any other asset class. You hear that at a young age and it just sticks with you. And so there's a lot of reasoning for that. Of course, you're owning a hard asset that has a high likelihood of increasing in value over time. You get a lot of tax benefits along the way too, through depreciation, to name that alone, that make real estate kind of stand out on its own, and it can provide income and growth. And so we find it to be one of the best places to put money.
Mm-hmm. Couldn't agree more. All right. Second question. What is a common mistake you see a lot of investors make?
So I think I'll break it out into 2 points, Shawn. If you're an active investor going out, sourcing the deals, acquiring them, financing them, making all the decisions, a common mistake is, especially if there's a value add play, we'll talk specifically about that, but is underestimating the time it's going to take to execute the business plan, and underestimating the cost that it's going to take to execute the business plan, and overestimating what it's going to be worth when you're done. And so if you do one of those 3, you might be okay. But if you do all 3, you're probably going to be in a little bit of a tough spot at the end of the business plan. And so from an active investment standpoint, those 3 tend to come to mind. Things tend to cost more and take longer than you think. And something that we've learned many years ago and continue to think about it today as an important point when looking at deals. From a passive investment standpoint, I would say, one mistake we see a lot of is just assuming that the operating partners are providing you with conservative, realistic projections. And that isn't always the case. A lot of times they're rosy and they're aggressive with their underwriting assumptions. And so looking at some of the underwriting, the analysis, and really trying to understand, where is this conservative? Ask that question. If you don't know and you can't see the conservative nature of their underwriting, then ask them, where do you think you've been conservative in your underwriting? And I think a lot of people just kind of take the projections as the reality. And a wise man once told me, financial projections in a pro forma, the question you really have to be asking when looking at them is, how wrong are they? Not how right are they, right? Because it's all assumptions and estimates of what things are going to do in the future. And so for me, the takeaway there is, look at the best case and worst case scenario, try and get comfortable with both and not just the best case, which is usually what's presented.
Yep. And it seems like today everybody's underwriting is conservative. And I'd have to question that with some of the the deals that we've lost, and hearing what other people's bid on. I was like, well, that doesn't seem too conservative to me. And those were all good points. I think they go hand in hand, right, Mark? Like, the 2 biggest levers you can pull when you're underwriting is, 1, the exit cap, right? So the valuation at the end, and then 2, how quickly and how big you're growing that NOI, and pulling those 2 levers can make a world of difference. So I'm glad you brought that up, because people need to understand that, because when we're underwriting, we go into it, doing everything we can to kill the deal. And if we can't kill it, then maybe we got something here and we need to look in a little further. Whereas I think some people get too wrapped up in emotions and they want to make the deal work because they want to get that next deal. And that can be very dangerous.
That's great. I agree. Well done, Shawn. Keep trying to kill them. That's the thing.
How many times
can you say no? Yeah.
And don't get me wrong, everyone that's listening, it can be defeating at some points, but I'd rather feel defeated at some points than not be able to sleep at night because, I put my investors' money in a bad position. So yeah, couldn't agree more, Mark. All right. Third question. What's a resource that maybe you do recommend or you would recommend to maybe a newer investor?
To a newer investor. So, I don't have a specific one, but I'll say this, when I started out, after kind of leaving corporate America, Shawn, looking for different investment opportunities, I just went networking my tail off. I would go to meetup groups all over town, once a week, every other week, whatever it was, for a couple of years straight. And now that, of course, we're past COVID and stay-at-home orders, I would urge folks to do that. Like, go look in your backyard, figure out what kind of talent and pedigree of people there are that are doing deals right behind you, right? And so go online, look up meetup groups, and start doing that. And then, as far as maybe another suggestion for a book. It's called Investing in Real Estate Private Equity by Shawn Cook. I don't know if you've heard of that one, Shawn.
I haven't. I'm going to take a look.
Yeah, it's got a lot of, it's a little more technical. It's got a lot of detail about partnership structure, waterfall structure, and really looking at the inner workings of what you and I do on a daily basis. So that's a good book to understand a little bit behind the scenes of how these deals are put together.
Well, thanks for that. I'm going to take a look at that. All right. Last question, Mark. The good old time machine. So if Mark was able to get into a time machine, go back to and see younger Mark, what's one piece of financial advice, Mark, that you tell yourself to hopefully set yourself up? Not that you don't have a great life, but for maybe get to that great life even faster.
Yeah. So you start saving as early as you start earning. And that can be, in your teens, right? And so we're so easy to spend at that age buying fun stuff, but most people don't think or aren't taught to, put different money in different buckets and different bank accounts. And so that's something that I think I wish I had done earlier from the day I started working. So I would suggest that. And one more point is going back to what I said previously is networking. You'll find people that are much better than you at certain things and try and find a way to learn from them, work with them, whatever it might be. So you're only as good as the people around you. And the earlier you do that, the better as well.
Love it. Yeah. Saving as early as you start learning. I like that. And yeah, networking, it's cliche, whatever you want to say, but your network is your net worth. It's true. Right. And I used to think, Mark, that, I had to do, everything on my own. Not because I knew everything. I knew I didn't, but because I thought that's how you had to do it, to get others' respect. But I realized that's not the case at all. And there's so many people that are way ahead of you that want to help you get to where they are. And so I think it's your point of not looking over your backyard either. Just get out there and see what people are doing and meet them.
Exactly. Well said.
Hey, Mark. Well, hey, I really appreciate your time coming on here. This was a killer show. So thank you. My pleasure, Shawn. Yeah, thanks for having me. All right. And listeners, as I always say, easy doesn't pay well and instant gratification is self-destructive. So not only get out there and work hard for your money, but have your money work hard for you and we can all create a better life. All right, everybody. Catch you on the next one.
Hey, this is Shawn Winslow. After being in the financial service industry for years and having candid conversations with good people just like you, I realized that so many of us are wanting an investment strategy that provides solid returns and consistent income without the bumps in the road. There's little known secret that your financial advisor doesn't want you to know. There is investment out there that is less volatile and the returns are stronger. Get more details by going to greenbriercg.com and clicking on the free e-report. And by the way, if this show has provided you any value, then feel free to leave an honest written review and of course share it with a friend who needs it. See you next week for another great show.